carry market risk. Past performance is never an indicator of future returns. And please make sure that you invest basis your risk profile across various opportunities that are available on Markets Mojo or outside for that matter, but make sure that your understanding of risk profile is clear. If not, let us know. We will do a webinar to make you understand that as well. Let's move. The internal view with which we are entering this particular year or maybe the next 3 to 6 months is that the market today looks overheated. When I say the market today looks overheated, it is especially in the mid and small cap segments that we personally feel that the market looks to be overheated. My next slide will tell you what our views are on an overall market basis. Now, if you look at the country's market cap to GDP ratio, this ratio, I don't know if any of you know, but it is very popularly known as the Buffett ratio, which is Warren Buffett. This was coined on his name. It is known as the Buffett ratio, which is the market cap to GDP ratio, which talks about primarily how a country is overall valued. Now, if you look at the current, which is 2024 market cap to GDP of India, it is at 130% approximately, which is 129%. Even if we feel that the market doesn't go anywhere, even if we feel that the GDP expands and the market doesn't go anywhere, in 2025 estimates it would still be at around 117%. The point to note here is that this is one of the highest market caps to GDP ratio that we are claiming today in India. Our last 15 years average has been as close to 82%. What does this say? Is that we are currently hugely overvalued as a market. As Indian market versus the GDP that we have and the GDP growth that we are claiming to have, the market is overheated as per the historical numbers. Now, having said that, you will see two boxes down. The first box has three countries, which is US, Japan and Canada, which talks about the higher than Indian market cap to GDP ratio. If you look at US, again very highly priced. US is today trading at around 200% as far as market cap to GDP ratio is concerned. Japan has 151% and Canada is at a 135%. Countries with lower ratios are China, which is 46%, Germany 58%, UK 99% and Korea 99%, France being at 117%. If you also look at another important factor when we look at the overall markets, we look at the TTM on a price to earnings ratio. We are currently at around 26 times, which is a very, very high ratio as far as the historical averages go. But having said that, before we go there, let's look at the mid-cap price to book. When we look at price to book, we again look at valuation now down to a particular market segment. If you look at the mid-cap price to book ratio, again we are at an all-time high, which basically means that today at a price to book on mid-cap at around 3.61, this is highest if you were to consider the last 10 to 15 years. Again, the meaning of this is that the mid-caps are very highly valued as per the current market price that we see today in the market. If you look at the next segment, which is the small cap, price to book is again at an all-time high. We are at around 3.5 times price to book on a small cap index side. Again, if you see over the last 10 to 15 years, this is the highest that we are trading today on the small cap side. Most of you feel, or the common perception in the market is that if the BJP comes in, then there is going to be a a further bull run, or there's going to be a further drive in the market? The answer to that is maybe not. The reason that we are saying is that most of the projections of BJP, now BJP is today projecting a unilateral win with around 400 odd seats. If you look at even that announcement when Mr. Modi spoke in the parliament a few weeks back and talked about the highest numbers in this particular election, market went up for a day or two and then it regained its natural path. So we personally believe
Unless
unless
BJP
BJP
loses,
loses,
BJP
BJP
win
win
is
is
already
already
factored in.
factored in.
So you may have a situation where you may feel that BJP winning is going to impact the prices and we will get into a renewed bull run in the market. The answer is very unlikely, primarily because BJP win is already factored in. What is not factored in into the pricing today is the BJP loss. Obviously, we all know that the chances of that are few, but the win has already been factored in. Moving forward, if you see the rate cut, a lot of expectation was there. In 2023, we had expectation that the rate cuts will start across the world. In fact, the projections that some of the US economists had for 2024 is that we'll have around 6 to 7 rate cuts. Answer is that 6 to 7 rate cuts do not look possible. We may end up having 0 to 3 rate cuts at maximum in the year 2024 calendar. Fed has been very clear that in the FOMC meeting in March, there is not a possibility of a rate cut. Job market data released recently shows a strong labor market, and RBI obviously maintained status quo on the 8th Feb MPC meeting. Similarly, the voicing across other central banks is also that they will maintain a status quo. So far in 2024, against a projection of 5 to 7 or 6 to 7 rate cuts, we are already now in the month of March, and we feel that assumption may not come true, and you may end up in a year with around 0 to 3 rate cuts. How much that rate cut would happen will depend a lot how the situation turns around. But so far, in the first quarter, which is March quarter, we are seeing neither US Fed moving, neither RBI moving, neither any of the central bank across the world moving towards a rate cut. So there doesn't seem to be any hurry on the rate cut front. One other factor, which was a lingering effect factor even in 2023, is still lingering on to us on a global economy basis in 2024. We are hearing some stress on the commercial real estate side of the US market. Now, if you understand the commercial real estate lending phenomena, you will know that close to 70% of the CRE loans, which is customer real estate outstanding loans in the US, are held by small banks. So small banks coming into stress in the US is a probability that we must consider as we are standing today. And this has been voiced even by Janet Yellen, that there may be some institutional stress on the commercial real estate side in the US. We've obviously seen one of the German banks also citing a similar commercial real estate crisis emerging in Europe. So commercial real estate segment is something which can create a little bit of a jitter in the market, especially in the US and some of the European countries. There is one point which still stands in the favor, and I thought we would highlight that one point, and if that is the price to book of Sensex, which means large cap, is still showing potential. If you see large cap price to book, we are today at 3.71, which is not absurdly high. which is quite in line of the last 10, 15 years average. If you see, the highest we had reached to is around 5.35, and we are currently at around 3.7. So there is not an extreme valuation situation that we are seeing on the large cap side, which is good news, because if all the three market caps are showing expensive valuations, there is one market cap which can be a shelter and a great strategy to look at when you're looking at conservation of capital and when you're looking at being in the market and still growing with the market. And what is very clearly coming out is large cap is one area which is still showing reasonable price to book ratio, not a very exaggerated one, as we've seen in the case of mid and small caps. So what, as you know, that when we do a research modeling, when we look at research modeling, we collaborate our IP and we see what is the IP saying. I'll just give you a simple example. In our PMS master, we have close to 100 odd stocks. There was a situation where out of these 100 odd stocks, we used to have 50 to 60 small caps. We used to have 30 to 40 mid caps, and we used to have around 10 large caps. That was a typical mix over the last year, or maybe if you were to look at 3 months or 5 months back, that was the mix. So predominantly, we used to be a small cap to a mid cap player as per the IP. What has radically changed over the last 2-3 months is that today, out of the same 100 as a basket, we are just getting 3-4 small caps. So the IP is moving very rapidly towards movement onto large caps, primarily because there is a conservation requirement that is coming into the market. And to conserve capital, when you say conserve capital, it doesn't mean to stay static. It means to grow in a conservative way. There is a move that we are seeing in the IP, which it is taking, which is move towards conservation. Now let's look at what does this mean, right? So if you go to the next slide, there are 4 changes that we are witnessing and we are doing as we are talking on the model portfolio. So I know a lot of you have model portfolios. Please understand there are 4 changes that the IP is doing on the model portfolios. One is we will actively move the small cap allocation to large caps, which is anyways happening because the master investment horizon or the investment universe of large cap is shrinking and small cap is shrinking and large cap is increasing. So the IP is going to move very rapidly from small cap allocation to large caps. Number 2, active profit booking in mid caps and reinvestment of that profit booking back to large caps is what is going to happen. So this is a time where you should book profits as actively as possible, and the IP is going to do that on the model portfolio side, especially on the mid cap side, because small cap is anyways fully moving towards large cap. Mid cap active profit booking will happen and move towards the large caps. Similarly, active loss booking. When the market anticipation is to go down, we have to make sure the VAR is very well disciplined, which is value at risk, which primarily means that we should have very strict discipline on booking losses, which is going to happen now, that we will very strictly look at booking losses into the portfolio so that we can take to point number 4, which is take that money and invest in fresh opportunities, primarily towards large cap. So these 4 things, again, to summarize, we are going to move from small cap allocation to large caps. We will do active profit booking in mid caps. Across the portfolio, we will do active loss booking, and the amount of loss booking or the profit booking that comes in from mid cap or the sale of small cap in the portfolio that comes in, that money will move towards allocation to high quality, high conviction large caps. What will this achieve? Now, one of the main questions is that all of this will achieve what? So please understand that market has a phase of up and down, right? You need to go aggressive with the market and you need to go conservative with the fall. So when you go aggressive with the upside, the alpha that you create more than the market is better. When you go more conservative than the market, the risk of losing capital or the risk of drawdown is better than the market. So for example, if the market does 15%, we are supposed to outperform when the market is going up. If the market does minus 15% or minus 10%, we should hedge ourselves so that we don't fall that much. There is no manager who will typically say market gaya 10% नीचे भी 15% नीचे भी हम तो पैसा बनाएंगे. But the only thing that you can do out there is that you can have a soft landing rather than a hard landing of the investment that you're doing, so that you ensure that your losses are controlled. And when the time comes, then your alpha, which is an upward market, more than compensates and grows much higher than the market. Overall, on a 5-year basis, you then outperformed by 100 basis point, by 1000 basis point, by 2000 basis point, depending on which kind of a portfolio you're invested in. By doing this move towards essential large cap, what we are doing is we are reducing the chances of underperformance in case the market falls. Now, the key out here is in case. We are guided by the IP, and the IP is suggesting us very clearly that there is a market fall that can be expected sooner or later. Ideally speaking, if you ask me, it should have started in Feb. But with the election results coming towards, say, May, I personally feel that government will be under a lot of pressure to maintain status quo in the market, to make sure that there's no drastic move in the market. Mr. Modi is talking about a 100-day plan. He's very confident he'll go in. But I think the whole fizzle will go out once the election comes in favor of BJP. So I think in the next quarter, market will seriously get tested. None of the global parameters are improving. Russia-Ukraine war is at a stagnate. You see the freight costs, which are up 100% because of this rerouting of freights that we have to do. So there's a lot of situation that is happening. You're seeing overvaluation. Market is not cracking so far. But if you ask me, in the next 3 months, there is a big chance that the market may crack. And hence, conservation of capital becomes key. If for some reason we go wrong on a call, we are still invested. So it's not that large cap won't give returns. It's not that large cap historically, if you actually see over the last 1 year, large cap has given better returns than small and mid. So by making this move, you are protecting the downside by keeping the upside potential still out there. And you're not taking any cash calls. We are fully invested, so recovery is built in. No one knows which way the market will move. It is anybody's guess. This is our guess that the market should go down. Every possible indicator should telling us that market should subside a little. There should be some healthy correction, predominantly on the mid and the small cap side. One of the things that you look at, if you look at the Feb a month data of the index performances, although large and mid cap had a little bit of a gain, small cap has lost in the month and month-to-month basis on a Feb basis. So there is a little bit of a correction that's already started and seeping in on the small cap basis, which we personally believe is going to be a little more on small cap, and then it will seep into the mid caps as well. One of the questions which the next slide will tell you that you need to, and you would always ask us, is why are you not recommending, or why is Markets Mojo not recommending taking cash calls in these markets, right? Should you be taking cash calls in these markets? Which means, should you be staying out? Should you be liquidating your holdings and staying out? The answer is an absolute certain no. 99% of you will lose money if you take a cash call. Cash call is a double-edged weapon, and it mostly or almost always goes wrong. We look back and we say we could have caught this point, we can catch this point, but trust me, when that recovery comes, and if you're not in the game at that point in time, you will miss much more than the sweat and the fear that you have today when you see the market gains coming back into the market, and market has a ability to fall and bounce back with equal vigor. Look at these two charts. I'm going to talk about the left chart first, which is in 2008. Sensex fell 30% in 6 months. 30% in 6 months. And what happened? It doubled in the next 6 months. So from a 30%, it doubled. If you look at 2020 scenario, there was almost a 30% drop in 3 months time this time, and a 62% in the next 9 months. तो अगर आपको लगता है कि ये नीचे गिर के मैं घुस जाऊंगा वापस अंदर, वो कभी होता नहीं है. That is not a possibility. That unless you take this drop and then you move with the market, it doesn't happen. Classical, let me just tell you, classical emotions that will come into play, right? One is to find the bottom. So for example, if the market cracks say 5%, you will say, okay, 5% correction aa gaya, should I enter? Because nobody knows whether it will be 5%, 10%, 12%, whatever it is, right? 10% aa gaya, should I enter? So when you invest, when you enter, if it is a 5% down market, it further goes down, then you will say, okay, now what will happen? So you will again go into that cycle that should I invest more, right? When the market is down, say 15, 20%, nobody is hoping for the market to go up. आप तो सोचना भी मत कि today if you take a cash call and the market corrects 15-20%, I will be the most courageous one to get in, because उस time everybody is sweating. Nobody has the courage of, because उस time वो doomsday scenario आ जाता है that everybody thinks that ये तो खत्म हो जाएगा. You know, market is already down 10-15%. Now it will go another 10-15% down, and that doomsday mentality comes in. At that point in time, to say that Abhi, I'm fully getting in, is a very, very evolved thought process. Very, very evolved. Forget thought process is a very evolved emotion, right? Because most of us know that money is made when the markets are lowest at investing at that level and booking profits when at the highest level. But most of us go wrong. Why? Not that we are stupid. It is because it's emotions that take over the logic at that time. And you will not believe how emotions can play havoc in your life. So do not try and control this chart. The only way to participate in this chart is to have that drop. I'm not saying 30%, I'm not saying any number, but to have and participate in the growth story. Otherwise, the market will not give you an opportunity to stay back when the bounce comes in. So active investment is all about movement in the right market cap at the right time and staying invested for the bounce back. Please, I'm requesting you. I have done this over the last 5-7 years. Some of you have heard me, some of you have not heard me. Do not take cash calls. Even if there's a drawdown in the portfolio, you will bless me when the upward movement comes in. This is not the time to act smart and take fund management decisions yourself. And what happens when the bad time comes? Large cap falls the least. Now, typically in 2022, if you look at Sensex fell by around 12.7%, BSE 500, which is the wider index, fell by 14.1%, mid cap fell by around 17%, and small caps fell at around 21%. So what we have to do is that if the index falls 12%, 7%, can we fall, say 5%, 6%, but be in the game so that when the rebound comes, then we quickly move back, or the IP guides us back to move into the mid cap and the small cap area so that we keep participating. Even if there is a little bit of a delay, we are still in the market. Yeah. We are expecting a similar trend. Now, we can be wrong, but please understand that the only thing that you are doing here is you are moving your mindset from being very aggressive to conservative and then back to very aggressive when the greed comes in. Right now, it is a fear scenario. And in the fear scenario, this is not the time to go aggressive. We personally believe that little bit of sharp correction may not come because government is going into election, but post-election it is going to be a free for all, which means that the fall can be much steeper post-election than pre-election, because the pre-election euphoria will continue even if there is a higher chance that BJP is going to come in, but that euphoria itself will continue, but that will lose sharp momentum as soon as BJP victory happens. As I said, that is already in the price. So if you're expecting the markets to go wildly after that, it is not something that we are seeing. Let's move. So very simply, do not take any cash calls. You will lose the highest potential of returns by exiting the markets when it rebounds. It is something that is not in our control. With that note, one more question that you may ask, that is this the right time to invest or add more to your portfolios? The answer is a very, very clear no. Investing at the dip, we will come back to you. We will tell you when the market is reasonably corrected that, guys, this is the time to invest more. But right now is not the time to. All the volume numbers are high. All the value numbers are high in the market. People are investing at these valuations. I personally believe that this is not the time to add fresh capital. Yes, if you're already allocated in the markets, do not take that money out. Maximum you can do is that move to a portfolio approach. You have model portfolios, you can move to a portfolio approach because that will smartly manage it. Or move to the PMS approach. If you are somebody who has more than 50 lakhs, you can move to the PMS approach. Let us manage it for you. But having said that, this is not the time to add extra money into the markets. We will tell you when there is a reasonable set of correction that may have happened, that I think the froth is out. This is a good time for us to go back into the market. We may be one and the only fund manager and advisor and research provider in the whole country who's today telling investors not to add fresh capital, right? Because typically it is against my business. We want you to add as much as capital, but this is not the time. We will come back to you and tell you when is the right time to invest more. Moving on, the products that we have, which is model portfolio, personal portfolio, Mojo Stocks, stock of the month, Mojo1 Strategies, trading 80 mutual funds. We have a lot of products, right? So we are today going to talk about every one of this and what you should be doing in all of this. We are going to make sure that this presentation also comes to you so that you don't need to take notes right now, but just hear it out. And once you have the presentation with you, you can then go down into detail. And if required, if you guys post on the Q&A, because this presentation will take around, another maybe 30 odd minutes, we can do a separate Q&A also after you guys have gone through this presentation in detail, maybe early next week or something. So with that note, to talk about model portfolio, what you need to do, personal portfolio, Mojo Stocks, stock of the month, let me hand it over to Karan to take it on a product by product basis in terms of what the strategy would be.
Thank you very much, Mohit. So indeed, as Mohit mentioned, the times are volatile, and in these times, please do not take a cash call. In the next few slides, what we'll tell you is how we are adapting our methodology to incorporate this market view in how we will recommend the stocks. Plus, what all you can do in your personal capacity, in your personal portfolio, and if you're managing your own investments, what are the strategies you can incorporate to ensure that we ride these volatile times and we come out on top. Again, very important, like Mohit stressed multiple times, please do not take a cash call because we can never time the market. No one can time the market. So, it sounds very fancy that, buy at the absolute bottom, but it is very difficult. And in that frame of mind, when the market is crashing, no one is in that psychological mind frame to actually take advantage of that. So please don't take cash calls. Please be invested, and we'll tell you how to manage your investments in these times. So if you are a model portfolio investor, First thing, like Mohit stressed, please do not increase exposure at the moment. Don't take out the money, don't take a cash call, but don't put fresh money in the model portfolios. We have already started aligning our model portfolios to incorporate our market view. So we've already started actively moving our allocations from small caps to high quality large caps. We've started doing active profit booking and loss booking in our strategy. So active profit booking in mid caps and loss booking across all stocks. In this time, we want to be nimble in our model portfolio. So if a stock falls beyond a certain percentage, where we think that okay, maybe it's corrected, the price movement is not correct, the valuations or the technicals are not supporting the price, there's not enough momentum, we'll actively be booking losses. So you might see cases where we're booking realized loss, but please, we are shifting that stock to a more high quality large cap so that we're able to tide over the coming volatility. Very, very important, please follow the suggestions in a disciplined manner. So, sometimes people come back to us and say that, there's been no transaction in my model portfolio for so long, for months at a stretch. That can happen. But because that's the design, what can also happen is in volatile times, there can be more transactions, which might happen now since we started, we've introduced these 3-4 new things. You might see more transactions happening in the near term. But please follow that in a disciplined manner. If you're following your model portfolio, please follow those suggestions and do not try and game it and do not say, okay, I'll follow part of it and part of it I'll manage on my own. Do that in your personal portfolio capacity. But if you're following a model portfolio, please be diligent. The whole idea of introducing a model portfolio is to inculcate that discipline in investing. So model portfolio, essentially what it is doing is it's telling you what to buy, how much to buy, when to sell, and what to buy next. So all this is automatically incorporated in the model portfolio strategy. As you all know, whenever we give a sell call in model portfolio, that reflects automatically, it updates automatically in your portfolio. You can always edit that and put in the actual price at which you sold it. And once you sell it and you put your actual price, you can generate the next buy call. What it does is, so earlier we used to give the buy call also automatically, but we realized that there might be lag. So you've not sold it for, let's say, 1 week, and then you go and you buy the old stock. So rather what now we do is, whenever you put the sell entry and whenever you have the cash, at that time when you generate the buy call, it will give you the best stock at that point of time. Right? So very important, model portfolio, like we're saying, please don't increase the exposure, but do not take a cash call. We've already started the move from small caps to more high quality large caps. We've already introduced active profit booking in mid caps and active loss booking across all strategies. And you'll increasingly see more large caps coming. So even if you create a new portfolio today, you'll see the bulk of it will be large caps. And that's by strategy, right? Please follow this in a disciplined manner. What can you do in your personal portfolio? Now, this is the portfolio that, let's say, you're managing on your own. First, if you have your personal portfolio, please be sure to put it on Markets Mojo, because then we can track and we can tell you what to do with these securities. We have a very holistic way of analyzing the portfolio. We just don't look at the stocks. We also look at how these stocks come together in a portfolio. So we look at the allocations across stocks, allocation across a single stock, across market caps, across your sectors, and see what is the profile of the portfolio and how you can make that bet. So please, if you have a personal portfolio that you manage on your own, please put that on Markets Mojo. It's very easy to import. You can import within seconds through multiple brokers. Now, once you have your updated portfolio, please ensure your portfolio is updated. Once that is updated, what you can do is you can head over to the portfolio optimizer section. It's a very, very powerful section. It sees your portfolio holistically and tells you how you can optimize it. You can make it much more stronger. There are 5 profiles that we've created. Your portfolio automatically gets bucketed into one of the profiles based on your transaction history, your holdings in the portfolio. What you can actively do is move from more aggressive strategies towards conservative strategies. So there are 5: very aggressive, moderate, conservative, and very conservative. Now, in times like these, when market is, we feel the market is going to be volatile, you can move actively to a more moderate conservative or a very conservative strategy, right? So you can probably, rule of thumb, wherever you think you fit, just move 2 steps to the right towards conservative portfolio. What this will do is the portfolio will start realigning. It will say, okay, of your stocks, which stocks you need to sell. And once it will also give you suggestions where you have to increase within your portfolio or which are the new stocks that you can add. Now, a more moderate or conservative portfolio will automatically allocate more towards large caps. What that also does is it sees the allocation to individual stocks that you have. So let's say an aggressive portfolio can have 10 to 12% in a stock, 15% in a stock also. But a more conservative portfolio will try and diversify the portfolio. So it automatically reduces the risk of your portfolio by diversifying into different, you can say, individual stocks, into different sectors, into different market segments. And it will automatically realign with a more, you can say, conservative mindset. So you'll have more large caps coming automatically in your portfolio. You can actively reduce allocation to lower rated small caps also. So, this is the time I think that you should not have, what we say is shadi kar liya stock se. Don't marry a stock. Don't be in love with a stock. Be practical, right? So if the parameters are suggesting the stock is not good investment at this point of time, we're not saying forever. At this point of time, if it's not a good stock, then please move to a higher rated stock. See, when the market is going up, market is going in one direction, then everything moves up, right? So even bad stocks will do well. But when the market is not doing well, what first thing happens is all the bad stocks get punished. So be practical, look at the ratings of stocks, actively move from lower rated small caps to large caps, actively reallocate from lower rated mid caps to large caps, do profit booking like we're saying, and do active loss. Now, here in the optimizer, you have to take these decisions yourself. We'll obviously guide you, like looking at the entire portfolio. This is how you should move your portfolio. But here the decision is with you. Once you optimize your portfolio, you're happy with this. So everywhere we give you multiple suggestions here. Right? So you'll get, let's say, if you say put in any 2 large caps, we'll give you 3 or 5 suggestions. So you can choose from these. All are good suggestions. But we're giving you the choice here because this you're managing personally. So once you're happy with your updated portfolio, you can always save that file, and you can even download a deal sheet that you can send to your broker directly. So in your personal portfolio, please use please have an updated portfolio. It's very, very important. Second, please use the optimizer and move towards more conservative to moderate strategies. Now, if you've invested in Mojo stock, Mojo stock is the list of top rated stocks, right? So these are already very highly rated stocks, all have a buy and strong buy rating. Plus, on top of that, these stocks have also passed through our investment committee filter. So there's a good quantitative assessment plus very good qualitative assessment. After that, the stock becomes part of the Mojo stock basket. Now, like Mohit was mentioning, in a PMS basket, if you see the Mojo stock basket also, bulk of the stocks, more than 50% of the stocks right now are large caps, and we're getting very few small and negligible micro caps in the Mojo stock list. So the IP is automatically suggesting that maybe a shift toward large cap is warranted, right? So since these stocks are already high quality, they've gone through multiple filters and they're in the list, that means they're still buy and strong buy. Please hold on to the stocks which are in the current list, but actively switch out of small and mid cap stocks which move out of the list, right? So when a stock moves out of Mojo stock, we say it's a list, so stocks can automatically keep moving up. But when a stock moves out from a buy rating, it is still a hold. What we are saying today is when a stock exits a Mojo stock, if it's a small or a mid cap stock, that time, even if the ratings hold, you can look to actively move to more high quality large caps that are still in the Mojo stock basket. So the stocks that are there in the list, please be in that, but actively get out of the stocks once they move out of the list. Again, do active profit booking in small and mid caps. Diversify your holdings and do not be concentrated. Although these are still all highly rated stocks, this is not the time to be in a very conservative portfolio mode. So you might say, okay, let me just pick up the top 5 stocks and I'll be in that. Now is not the time. That might be a great strategy when the market is going in one direction, but when the market looks choppy, you need to diversify your holdings. So don't be concentrated in just a few stocks. Do not have more than your 10% of your holdings in any one stock. So move from from concentration to diversification. Diversify across multiple stocks. Move from small and mid cap stocks that exit the list to more high quality large caps that are either there or are new entrants. Stock of the month. Like Mojo Stocks, stock of the month again are very highly rated stocks. These have been extremely researched in depth by investment committee. But you already are seeing the change in the strategy that we've incorporated in stock of the month. Even when we're presenting the last stock of the month, we specifically mentioned that being in line with the view of what we're thinking the market might happen, and that has already started happening, like Mohit said, in the month of February. We're moving to more high quality large caps, and even going forward for the next couple of months, we will be in more high quality large caps. So we already have enough. So stock of the month come from Mojo Stocks, and again, the Mojo Stock basket is now increasingly from large caps. And the next couple of stocks, again, in line with the view, will be from high quality large caps, which have a very sustainable business and good brand recall, right? Because in volatile markets, these are the stocks that tend to fall less because they have a proven business record. They are not stories. They have actual numbers to back it up. And they have a very strong brand recall. So that automatically creates what we call as moat, right, for the stock. Hold again, like Mojo Stocks, please hold on to the stocks in the current list and actively switch out of the stocks which move out of the list. Because the market now has started becoming volatile, you would have noticed in the last months there have been a couple of exits from the stock of the month list. So whenever there are exits, please actively move out because these stocks might still be hold on the side, but please actively move out and move into more recent large caps which enter the list. Again, not the time to be concentrated. Please diversify your holdings. Do not have more than 10% in a single stock, and ideally you should have at least 20-25 stocks if you're moving to a more conservative mindset. Now the Mojo1 strategy. So Mojo1 launched around Diwali last year in November. We launched 3 new strategies. Now the whole idea here was to have a broader spectrum of stocks. So people have different investments need. And so Mojo Stocks is catering to people who want high quality stocks with good momentum. They're all highly rated, high quality, but people might have different needs, right? So people want turnaround stories. People want the next multi-bagger. People want consistent performance. And that's why we came out with 3 new products of hidden turnaround, momentum, and reliable performance. Now, all 3 have a very different mix of how the stocks are selected, and let's go through each of them. Turnaround companies. Now, turnaround companies are inherently highly risky stocks, right? Because these stocks have started showing signs of turnaround. They've not really turnaround. We don't know if they will be able to sustain this turnaround with consistent performance going forward. So these stocks inherently are very risky. They do have potential of very high return, but in volatile times, they can be very, they can fall down. This strategy should only be followed by people who can stomach the volatility that might happen, and they're okay to absorb the losses in the short term. Because when the market falls, these stocks, which still do not have a proven record, so we just spoke about stock of the month with stocks that have proven record. These stocks will not have that. These are just started to turn around their performance. So these can be susceptible to falling a lot in these markets. So you have to be careful. Now, we're not saying these are bad stocks, but they should be followed by people who can stomach the volatility because they're highly risky stocks. But it's very important right now to diversify your portfolio. Now, I've stressed on the word diversification a couple of times. It's very important. And please do not have more than 30% of your corpus in hidden turnarounds. And please follow this only if you can stomach the volatility in these stocks. Second, momentum now stocks. Momentum now stocks are the stocks which have good fundamental momentum and good price momentum, right? So they have both the short-term indicators in favor. So, and they've shown that sign of continuing momentum for some time. Now, again, what happens when the market turns, right? The stocks which have shown high momentum, the market will they will book profit in these stocks because they've already rallied. So people want to book profits before they lose on to their gains. So please do active profit booking again in small and mid caps. In all these three strategies, we have introduced stock level risk assessment, and we will do that very, very diligently. If the stock falls beyond a limit, or we feel the profit has to be booked at this level, we'll be very active to tell you regarding this. But please follow that. Please be very active doing profit booking in small and mid caps, and look for opportunities coming in the mid and large cap segment. By the nature of the product, there might be new opportunities coming in micro caps, small caps, but at this point of time, you might want to move to more mid and large caps. Third are reliable performers. These are the stocks which have time and time again given good results. So they have been consistent in terms of their fundamental performance. That's why we call them reliable performers. Now, these stocks are fundamentally strong, right? Because they have time and time again given good results, but in depressed markets, right? Again, stocks have done well consistently. The stock price might have risen. When the market turns, people want to book profits, and these stocks might also not be spared, because by the nature also, again, these stocks are not mega caps of what we are trying to identify here. These might still be mid to large cap stocks. Again, do active profit booking whenever it comes to small and mid caps, and look for opportunities coming in more large cap segment. And the market, the way results are coming also, a lot of large and mega cap companies have also started giving consistent results, and you might want to look for opportunities in those spaces. Trading AT is the product where we give short-term technical calls, short-term trading calls. Now, these are weekly and monthly trading calls, and these calls, they're not connected with the stock's fundamental at all. So please never see that, okay, it's a buy on trading AT, but it has a sell rating on markets, because those are completely, not connected. A stock, here we're only looking at short-term signals that the stock is giving in terms of its, price movement and volumes. So in volatile times, you have to be very careful when trading. Now, this is, I cannot stress more on the second point. Please don't take leverage to trade, because that can get very, very difficult in times of, when the calls do not go right. And, we never tell anyone to take leverage and invest in stocks. Your overall exposure, now I'm saying exposure, I'm not talking about your investment, I'm saying exposure, because whenever you trade, essentially you, how much ever I will say, people will trade on margin. So your exposure, which is what is the amount of call that you're taking, that should never be more than 5%, and especially in this market should not be more than 5% of your entire holding value. So let's say you hold 100 rupees, your total holdings in stocks is 100 rupees. Don't take exposure of more than 5 rupees. So you might be only putting margin of 1 rupee and taking an exposure of 5 rupee. In bad market, it can all be wiped out, right? So don't take exposure of more than 5 rupees is what I'm seeing in this scenario. Very important, please adhere to strict stop loss. Whenever you're following any trading call, please adhere to very strict stop loss scenario. Mutual funds. So mutual funds, the way people invest, and the most common way of investing is SIP. And in volatile market, actually SIPs turn out to be pretty good investments. So what happens is, when the market is going up and down, you automatically average. So what we are also stressing is, don't take a cash call. When you continue your SIPs, you're not taking a cash call. So you automatically tend to keep investing when the market is down, and that benefits you when the markets eventually rise. So don't stop your SIPs, but what I would really say is, move to higher rated funds. So within categories, you can explore Markets Mojo's rating, where we do a very in-depth analysis of every fund in every category, right? So in that specific category, you might want to shift to high rated funds. Actively exit sell rated funds and move to more high rated in the same category because that's available. What you should keep in mind whenever you're investing in mutual funds, because mutual funds is a vehicle through which you can invest in debt, you can invest in stocks, in cash instruments. So, your whole entire asset allocation happens. Don't deviate from your strategic allocation. Strategic allocation is a long term. Let's say you decided that in the long term you'll invest 60 to 70% in equities. Let's say that's a strategic allocation. So don't deviate from that. In volatile markets, you might want to adjust it slightly, but have the broader framework in mind and don't deviate from your strategic allocation. Like I said, in bad markets, SIPs actually are good investment vehicles. So you might want to continue that. Very important, we will inform you whenever the time is right to invest more. We are actively saying that now is not the time to put in more money. We will ourselves come back to you and tell you now is the time that you can start investing again. Plus, we will also come back and tell you when is the right time to move to small caps. Like we've already started adjusting our allocation to move to more large caps. We will again start adjusting our move to more small caps whenever we feel the time is right, whenever the healthy correction that we are anticipating has happened, and whenever the time is right to again move back to small cap. Whenever IP is suggesting that move back to small caps, we will again come back to you and tell you when to shift your investment strategy. So earlier we showed you a slide where we said, okay, when the market is bad, the large caps tend to fall the least, while mid and small caps actually fall a lot. Now, this is the other slide. Whenever market stabilizes, that's the time when small caps actually outperform, small and mid caps outperform the broader large cap markets by a big alpha. So this happened on multiple occasions. So in 2017, when the market stabilized and it finally went up, Sensex went up 28%, which is very high. But small caps were up almost 60%, mid caps 48%. In 2020, when markets, Sensex was up 16%, mid caps were 20%, small caps 32%. Again, 2021, Sensex 22, mid caps 39, small caps 62%. And in 2023 also this has happened when Sensex was 18.5%, mid caps went up 45% and small cap 47%. So yes, when the market falls, large caps fall less, and that's what our call is. But whenever we feel that the market has stabilized, we might not be able to catch the absolute bottom. We're not saying that. But when we feel the market is now stabilized, we will come back to you and tell you, okay, now the time is right. Market is showing signs of recovery, and now is the time to get back to small cap allocation, put in more money so that we can ride this wave. So again, the recent move to large cap is temporary based on the IP. And again, whenever the market, we feel the situation has improved and our IP suggests move to small caps, again, we'll have the similar presentation. We'll give you the rationale and tell you now the time to move. Very important, please remember the golden rule. Throughout history, we have seen that those willing to hold on during rough times are usually who are rewarded in the end. Hence, patience and discipline are the key in this market. With that, we'll open the floor for Q&A.
So this first question is from Mr. Ashok. What should be done after booking profit? We should reinvest in new stocks as suggested by model portfolio, or profit should be kept for future investment?
No, as we suggested, that profits have to be reinvested back into high quality large caps. That is about staying in the market. If you take the profits out, that means actually you're taking a cash call, and which we clearly said that cash call is not the best option in these markets. When the model portfolio will suggest you a profit booking, it will automatically give you a new stock, which will be a high quality large cap stock to put your money in. So please stay invested. Reinvest your profits back into high quality large cap, because that's the only way you're staying in the market. Do not take money out, because that is taking cash call. Whether you take profit booking out, whether you take loss booking out, whether you cash out, all of those are cash out possibilities, and you do not need to do that. You just need to follow the IP, and we will tell you which stock to invest in once we do a profit booking, and you need to invest in that stock.
So this next question is from Mr. Amit. Hi Mohit, I've been following you for almost 3 years now. I have entered into market with a long-term 3 to 5 years vision, already sitting on huge profits. So why the real rejig? What will I achieve by doing this juggle?
No, you may be sitting on a real a lot of profit, Amit. But we are an active manager. The active manager will tell you how to be greedy in greedy times and how to be fearful in fearful times. Normally, people are the other way around, right? So now today, when we are seeing that there is a correction that may come in that may erode certain bit of capital, our job is to make sure that the erosion is as less as possible, right? So, and any smart manager would do that, in a multi-cap. Why do you invest in a multi-cap strategy? Because the essence of a multi-cap strategy, like if you see aggressive strategy of model portfolio, if you see our PMS, the essence is that you can move into market caps. Why would you move into a large cap fully or a mid cap or a small cap? Is because you see potential of growth out there. Today, if you see potential of degrowth in a small cap or in a mid cap, you will basically move towards a large cap one, which basically makes your portfolio a little more conservative in its approach. If the index falls 15%, I don't want to fall 35, 40%. I don't want your investments to fall. When the index starts recovering, you can be rest assured we will be the first ones, and we've always been the first one to come back and say that we are taking the small cap exposure or mid cap exposure back to say 60, 70% because this is the time to ride on the wave now. So active management is not a buy hold, that if you are buying certain things, you need to just hold it for eternity, right? Active management is to make sure that move along with the trends of the market, respect the market, and you are doing a model which is, as I call it, I used to call this model, and a lot of you may have heard this, is a con grow, which is you got to conserve when you have to conserve, you have to grow when you have to grow. Even if I can conserve a 10%, even if I can conserve a 15% by making sure this move happens and go back into the small and mid cap category when the rise comes in, I think you will understand on a larger basis, 10, 15%, on a yearly basis, a large amount to save when you are clearly seeing indicators which are not looking good for the market today.
So this next question is from Ms. Vishali. When US, Japan, Europe market are hitting all-time high, does valuation is the only reason to see fall in small and mid cap? Should we sell small cap mutual funds and shift to Sensex and Nifty ETFs?
No, we are not looking at only the small cap trends. In fact, we are saying that overall market will correct. See, we are not saying that the small caps will correct. What we are saying is that the overall market, if you look at my first slide, I said that the market cap to GDP, not small cap, not large cap, not mid cap, market cap, Indian market cap to GDP is trading at 129, 130 almost. So we are basically saying that the whole market is overvalued. Now, within that market, there are components, right? So within that market, there is a large cap, there is a mid cap, there's small cap. Mid and small cap are looking extremely more overvalued than the large cap. And hence, when the correction comes in, the first thing that will happen is that the most overvalued thing will first do the course correction downwards. So small and mid cap will fall much more than the index as on today. So it may be a good strategy to go into not ETF at this point in time, but a well-managed large cap portfolio. If you even get out of mutual fund, and if you're trying to create a high quality large cap portfolio, I would suggest that go and create a, aggressive to a moderate model portfolio. Either that's option number one on Markets Mojo and you can invest in that. Or option number B is that in the mutual fund section of Markets Mojo, go in for a large cap active managed fund and you can invest it out there.
So this next question is from Mr. Sharad. I have a 1 CR portfolio with 235 stocks. If your team can take over the portfolio and switch 50 lakhs to your PMS by selling the weakest stocks in the portfolio, I shall be obliged. I would like an in-person meeting with you to kickstart the process.
We can do that, sir, but 235 stocks across 1 crore portfolio is an absolute, I would say it's the absolute wrong approach. You may end up in less than FD returns or negative returns, because cross cannibalization of such a big holding is bound to happen. In fact, mutual funds go in with a 50 stock and they still can't beat the index. You are holding 235 stocks. So I would definitely want to do that meeting with you. Karan, if you can take down the email, maybe you can put your email address on the chat box or your contact details, and we'll set up a meeting. We would be most happy to help you and realign your portfolio. But please make sure that your portfolio is made. It is not, as we say that portfolio kaise bana, portfolio ban gaya, because you kept buying things over a period of time and then it got accumulated and you had so many stocks. There is a huge difference in smartly managed portfolio versus portfolios that are made over a period of time because you keep collecting stocks and you feel that chalta rahega ye and something will happen. But across the 235 stocks are very difficult to even generate 1% positive return. And if you have been generating, I think it's all congratulations. But I personally feel that in a 235 stock, I would expect a negative return always, primarily because of the cross cannibalization. 30, 40, 50 stocks I can understand, but and this is not you, this I'm talking to the other investors as well, because I've seen a lot of investors having 20 mutual fund schemes. जो नया स्कीम आया उसमें चालू कर दिया, जिसमें इसमें डाल दिया, कोई आरएम आया उसको चालू कर दिया. वो 20 म्यूचुअल फंड स्कीम से क्या हो जाएगा? ओवरऑल पोर्टफोलियो लेवल पे कुछ नहीं होने वाला है, right? Because you are basically invested in the whole market. You may as well sell everything and invest in the ETF. That's a better approach to take rather than buying 20 SIPs or 20 mutual funds. So to cut the long story short, would be most delighted to help you with it. Send us your details, and you can put it on the chat box also, and we will at the earliest set up a meeting with you.
Also, I'll just add one thing here. What happens is when you have so many stocks, actually what you've invested in one single stock is so low that it will not impact your overall portfolio. So let's say you found a great stock at the right time and you invested in that. So more than 200 stocks means you're not even investing 0.5% in one stock. Now, if that stock doubles, right, in let's say 1 month, you'll only make 0.5% on your portfolio, if you see in terms of performance. So it's very, very important to put the right money behind the right stocks, because if till the time you don't put the right sort of money, you'll not be able to realize the profits from your investment. So yes, sir, do share your details, and we'll set up a call. We'll do a very thorough analysis of your portfolio, and we'll let you know how you can really optimize it.
So this next question is from Mr. Yogesh. Hi Karan, should we move to very attractive valuation stocks?
So, we always say that whenever you're looking at a stock, please don't look at one particular dot in isolation. See, the whole beauty about Markets Mojo's research of the 4 dots is, it looks at a stock from multiple different angles, from a long-term quality in terms of the sustainability of the business to, let's say, the near-term financial trend, which is how the company is doing its latest results. Similarly, in valuation, how is the price versus fundamentals, and the technicals is how is the price trend, right? So technicals and valuation will kind of move. If a stock is doing very well, the technicals start looking bullish, but at the same time, the stock start looking expensive. So the whole, beauty of Markets Mojo's score from 0 to 100 is it automatically takes all these 4 different components and gives rating to a stock. Plus, our model is dynamic, so it constantly adjusts the weights across these 4 parameters to give you one call. So my personal opinion here is, whenever you're looking at a stock, please look at the overall score combined rather than looking at one particular dot. But, ultimately it's your decision. If you're looking at very, very deep value stocks, this might be a strategy. But I personally would go with a stocks.
So this question is from Mr. Vinay. I have created a Diwali Mojo1 portfolio and also realigned as per Mr. Karan Batra's updates. What is the view on Diwali Mojo1 portfolio in views of the changes being announced today?
See,
So
Diwali.
Diwali,
Sorry, Karan, go ahead. Sorry.
so Diwali portfolio is, like we said about the other Mojo stocks and stock of the month, this is a portfolio of very good quality stocks. And we've personally done a second level of check of all these stocks. So whenever a stock moves out of the criteria, now we had a very specific criteria of picking each and every stock, right? So every stock was picked because of some particular criteria, whether it was from Mojo stocks or even when we're looking at hidden turnaround, in that also we applied another level of analysis to pick those stocks. So those stocks are, yes, quantitatively very good and also have been qualitatively assessed. We will continue to track these stocks in our weekly webinar. So we have the update tomorrow and we'll tell you if there's any further alignment required. But yes, rest assured, we are applying the same thought process across all the strategies, across all the suggestions we've given you. And if there is any change, we'll definitely come back. But again, all the stocks that we did recommend were, there was another level of deep research that we did on top of just the numbers of the company.
So this next question is from Mr. Raju. Dear Mohit sir, do we need to take aggressive calls on booking losses? And secondly, what should be the percentage allocation in large, mid, and small? And what should be the call on high rated 75 plus score small and mid cap stocks?
So when you say disciplined, aggressive calls on loss booking, I would say yes. See, again, that aggression is something that depends on what your risk profile is, and we've already built that into the model portfolio. Individually, what allocation you should play in between large, mid, and small is a very risk profile driven question that you're asking me. And I may not be able to answer that, but I would say that substantial amount should be there on the large cap side as we are talking today, primarily because of this whole market scenario that we are talking, which is a temporary market scenario. It can last for 3 months, 6 months, sometimes maybe more. And once that froth is of extra valuation moves out of the market, we will tell you when to go back on the aggressive note. And sorry, what was the third question, Mehta?
So it's about the Mojo stocks which are rated 75 plus, which are small and mid caps. Should we
See,
go
again,
ahead with them?
yeah, so mid cap and small cap, even at the score of 75 plus, are going to get beaten down because when you have a rally which is going towards beating down the overall small caps and mid caps, you will have correction, which will be to compare that if you have a 75 plus large cap versus a 75 plus score of a mid and a small, I think the dip will be lower in the 75 large cap category than in the mid and the small cap. So it is not that if a small cap stock or a mid cap stock is say 80 rated or 85 rated, it is going to fall less. When a market cap beating happens, when, for example, today, if you look at, just to give you an interesting data point, SEBI has gone to all the mutual funds and said that reassess your mid and small cap portfolios, primarily because if the exposure is higher than the volumes that are being traded out there, and over a period of time, the institutional holding in small and mid cap companies has become very high. So when the market turn happens and when the mutual funds start moving more conservative towards, say, from a mid and small cap to the large cap side, then fundamentals don't play, because then it will become a dumping ground. Because the quantity is so huge, and if they have to exit, and if the volumes shrink, even if they have to exit something, large quantity, when the shrinkage of the volume happens, then typically there will be a big hurry of moving from small to large. And I think we are only preempting this particular situation and saying that if you have more stocks which are over 75 rated, which are large cap, why would I not invest in that? Because that has the capacity to grow, that has the capacity to fall less. And obviously, we'll guide you when to take that exposure back to mid and small. So I would still say that focus more on 75 plus or 70 plus stocks, which are on the large cap side than on mid and small.
This next question is from Mr. Rachit. Considering the market scenario, are there any offers on Mojo1 subscription?
We have some great offers that are going on. Karan, what is the current offer that we have? I think we are just about closing that offer.
Yes, we had introduced the Mojo1 Diwali offer for very, very short time, and I think we're closing it tonight, which is for 29,999. You will get access to 2 years plus 1 year extra of Mojo1, and on top of that, you're also getting 6 months of InfinHub. So we're going to close that offer very soon. But Mehtab, just take down the details, and we can probably share the link again with Mr. Rachit.
Sure. So this next question is from Mr. Kalpit. Sir, what is your view on the SEBI circular to mutual fund industries to reduce exposure in small cap scheme? Is it the right time to exit from small cap mutual fund or stock? Which are more affected? Can you give briefing about this issue?
Yeah, that is exactly, in fact, what I was pointing out, that the result of the SEBI circular to the mutual funds. Primarily, SEBI is worried about the downward market trend or the spiral that the selling of the large holdings of small cap in the mutual fund portfolios that it can possibly create. And that is something that, if you ask me, is going to happen because sometimes when you have negative news that will start coming in, there is going to be a dumping exercise that will happen. And hence, SEBI is evaluating very closely with the mutual funds in terms of their small cap holdings, whether the volume of the small caps that they're holding, what kind of trading days that they will take to liquidate that particular volume, what is the quantity that they're holding. So all of that stuff is under discussion today. And I personally feel that SEBI is doing the right thing because, like, we are anticipating something, even SEBI is anticipating that in case there is a fall that comes, then how are we going to manage the holdings? Because mutual fund is an instrument of smaller investors. And, drastic movement when the volumes shrink, when you go and sell the same quantity today versus when the volumes are half, and you try and sell the same quantity when the volumes are half, the impact is huge. Single stock impact can be 30, 40, 50% down, right? Just because the volumes are not there. So this is a very valid question. And I personally feel that we should be very careful in taking pure small cap funds today. So if it is a multi-cap diversified fund of mutual fund scheme, then it's fine because I think the fund manager will slowly move towards mid and large. But if it is by nature a small cap fund that you've invested in, then I think that has higher chance of correction than a multi-strategy fund on mutual fund, which is internally built in to move market caps.
This next question is from Miss Lata. Can we enter model portfolio now? Like if I have some spare money from matured FDs or something like that?
You can enter, as I said, that if it is a part of equity allocation, I would suggest you enter. But if you're investing this amount from FDs to move in, which was not a part of your equity allocation, I would say wait for some time. Let the market froth move out by at least a 10% or 10-15%. And then I think it will be a better time to invest new money out there. Since you're saying, should I liquidate FD or FD liquidation money is with you and you want to invest, I'm assuming it's new money. I personally feel that I would not suggest you to add new allocation today. I would say wait for 2-3 months or 2-3-4 months, park it into 3-4 months or maybe 5-month FD. And then we'll tell you when to move in. If it is already equity money, in mutual fund, in listed equities, that means it's already in equity. That is fine. That don't take out. But don't, push in more money into your portfolios today.
So this next question is from Mr. Ravi. So he's asking, is it not a good time to move to large cap PSU stocks? How about bank stocks?
See, specific sector rotation is very fast, Ravi. PSU stocks also, I feel, is riding a lot on the election story. And I think that just follow the IP on, and we capture this beautifully in the large cap area. In fact, our large cap calls are one of the best in the market as well. I would say if I were you, I would straight away go to the Mojo Stocks and look at large cap companies out there. It'll throw up very decent 5-10 companies to put my hook on out there and just follow that. Do not be sector specific. When US banking is in stress, banking across the world can come in stress, right? So I do not want us to be very sector specific. I just expect that you guys do one thing, which is just follow the site very thoroughly, right? When we are telling you something, don't look at, "Arey, ye stock liya to 4%, 10% niche ho gaya," and all the stuff, because you don't know what you would have otherwise bought, right? Which and where that would have gone. The best way to play right now is either put it in model portfolio, either put it in PMS if you're 50 lakh plus client, or if you want to do your own investment, stick to Mojo1 products, which is, conservative, and within that, stick to more of the large cap opportunities. And large cap opportunities are there enough today, will be there enough tomorrow, whether PSU or non-PSU, but wo aata rahega, and we just follow that.
So this next question is for Mr. Karan. Mr. Udayang is asking, please share us the strategies for averaging down and pyramid up.
For averaging down and pyramid up. Okay, so I think one thing I just keep saying, that you cannot time the market. Please don't try to time the market in terms of when to buy and sell. We always say that put in the money, like put in more money when you have it, and don't think that when you're timing it or not. But right now we're saying don't even push, fresh money in. So please stay invested with what you have. Please stay invested in the model portfolio approach, because that is automatically catering to, if you have to buy more of the same stock, sell something, do profit booking, and where to allocate it. So personally, in this time when we're saying that don't add fresh money, I cannot even suggest that when to average down or average up. Don't put in more money, be invested in equity allocation, but realign your equity allocation to more high quality large caps.
So this question is from Mr. Murlidhar. So please tell me what's happening about the InfinHub updates.
Sir, InfinHub new IP is already gone live. We are doing a big launch on InfinHub very soon. So across 20 odd countries, we have put in the new IP, which has already gone live. We are now reflecting the model portfolio changes very soon. So I would say bringing InfinHub up to the India level of IP performance has already happened. Many congratulations to you and my team who have relentlessly worked over the last 1.5 years now to bring it up. We are waiting for a big launch that we'll do and reveal you all the IP results. So just stay with us for a week or 2 weeks, and there is a big launch that we will do of InfinHub for all our InfinHub investors. And make sure that, our results are very good. I'm very happy with the results. And this is something that I personally have struggled the most over the last 2 years, because there were multiple countries and all that. But to tell you the least, we've finally reached where we wanted to reach over the last 3-4 years. We will come back to you and talk to you more about it. So just give us some time on that.
So that's it with the Q&A, sir.
All right, thanks a lot. If you guys still feel that we need to do only one webinar fully on the Q&A side on the current market scenario and investment strategy, please drop in you can say a yes on the chat box, and we will make sure that we do a separate Q&A and only a Q&A with me and Karan on all your investment questions. We can do that, provided you're interested in doing that, and we will take it on from there. With that note, thanks everybody, and hope to see you soon.
Thank you very much.